Hey everyone, hope you're doing well. Chris here from the Business Report Show. In this video, I will be talking about the top 3 stocks I'm putting on my radar for the month of February. Before I begin, make sure to hit the subscribe button, and if you do enjoy the video, make sure to give it a like. Every little bit helps. As a disclaimer, I am not a financial planner or advisor, and everything I say in this video is just my opinion and for educational purposes only. Make sure to seek a professional before you start investing. Alright, let's dive right into it. In no particular order, let's get started with Mercury General, ticker symbol MCY, listed on New York Stock Exchange. Mercury General is a multi-line insurance company offering personal automobile, homeowners, renters, and business insurance. Started in 1961, founder George Joseph wanted to offer customers a low-cost alternative to larger insurance companies at that time. Today, Mercury General has more than 4,500 employees, manages in excess of $4 billion in assets, and has a current market capitalization of $3 billion. So let's go take a look at some of the financial metrics. 3-year revenue growth has been positive and comes in at approximately 7%. Just like most companies during 2020, it did take a bit of a dip at both its earnings and its stock price, but it has rebounded nicely since. Looking at the last 5-quarter financials, net income has fluctuated in negative and positive territory, but overall has increased from this period. One of the biggest items that affect insurance company financials are their large damage payouts. So in 2018, you will see a huge dip in net income because Mercury took tremendous losses in covering damages from the wildfires in California. At the same time, because of the consistent stream of insurance premiums from customers, cash flow figures are quite healthy for Mercury General. The company also paid a consistent and growing dividend every quarter since 1991, with the exception of one quarter back in 2001 during the dot-com crisis. The current dividend yield is an impressive 4.67%. Now let's take a look at some of the various valuation metrics. I like to pick at least 2 so that I get good coverage from multiple methods, because all valuation metrics will rely on some level of estimates and nothing in the future is guaranteed. But these metrics will give us a good sense of whether or not the current share price is under or overvalued. I would normally look at discounted cash flow model based on free cash flow, but because of Mercury's tremendous growth in free cash flow year over year, which is positive, it might throw the true valuation off a little bit. Using this model, we can see that the fair value comes out to $246 per share, which is a significant upside value from the current price of $54 per share. Instead, because Mercury has had consistent dividends and we can map out the growth rate for the last 2 decades, I will look at the dividend discount model. Using this calculation, we see that the fair value is around $52.58, slightly below the current market price. The next metric we should take a look at is the multiples calculation based on the income statement. This calculation requires the company to have positive operating profit, so not a metric applicable for high growth stocks like Tesla, for example. Now, based on this calculation, it shows that Mercury has a valuation of $58.48 per share, which means the current share price is close to this valuation outcome. One last metric we'll take a look at is the absolute PE method, which I like better than the standard PE valuation because it takes into consideration multiple conditions including earnings growth rate, dividend yield, business risk, financial risk, and earnings visibility. The absolute PE calculation for Mercury shows a fair value of $83.44, which means based on this calculation, there's still a good potential for upside on the current share price. So my overall thoughts on Mercury General is that it is a good stable stock that would fit nicely in your value investment part of your portfolio. The dividend yield is on the higher end for value plays, and while they are trading close to a 52-week high, it is still trading below their high of $65 during the last 2 years. Now, the various valuation metrics range from $52 to $83, so from a long-term investment standpoint, I would keep this one on your radar and look for a slight dip before entering. My only big concern about Mercury is the aggressive push by new technology startups into the insurance world. Companies like Root are looking to disrupt the auto insurance industry, and due to their ability to scale and attract the millennial market, Mercury's client base may be shrinking in the long term. Perhaps a possible play is to purchase both Mercury and Root so that you earn money while waiting for growth of companies like Root and Lemonade. Now, the second stock is Central Pacific Financial, ticker symbol CPF on the New York Stock Exchange. Central Pacific Financial is an American regional commercial bank headquartered in Honolulu, Hawaii, and is the fourth largest bank in the region. It was founded in 1954 by a small group of World War II veterans with a mission to help local families and small businesses who had been traditionally ignored by the big banking establishments. Today, Central Pacific has 72 banking locations across Hawaii and has 854 employees with $6.59 billion in assets and has a current market capitalization of $611 million. Let's take a look at some of the financial metrics. So revenue over the last 5 years has continued to grow each year, with the last 3 years showing revenue growth of approximately 11%. Just like many banks during 2020, the stock price did take a dip in March but has slowly recovered, although still not reaching its 52-week high. Looking at the last 5 quarterly financials, net income has remained flat and in fact has recovered from the slight drop in revenue in March of 2020 and is back to its pre-COVID level of revenues. One of the biggest items that affect the banking company's financials are the allocation of loan loss provisions. So during the global pandemic, we have seen many banks offer mortgage loan deferrals for both residential and commercial customers to help cope with the drop in income and business revenues. For purpose of regulations, the bank needed to increase loan loss provisions by more than twice, which negatively affects the balance sheet even if actual loan losses are not experienced. The company has also paid a consistent and growing dividend every quarter since 2015, with the current dividend yield at a decent 4.24%. Now let's take a look at some of the various valuation metrics. Looking at the discounted cash flow model based on free cash flow, we see a fair value of $23.13 per share, slightly above the current share price of $21.68. Using the dividend discount model, we see that the fair value is $21.54, slightly below the current share price. The next metric is the multiples calculation, and based on this calculation, it shows Central Pacific has a valuation of $22.46 per share, slightly above current share price. The last metric I want to take a look at for Century Pacific is their absolute PE method, and the calculation shows a fair value of $29.65, which means based on this calculation, there is good upside based on the current share price. So my overall thoughts on Central Pacific is that it is a stock worth looking at for your value investment portfolio. The dividend yield is on the higher end for value plays, and there's still room for growth to hit their 52-week high of $29.09. The various valuation metrics range from $21.54 to $29.65, so just like Mercury, from a long-term investment standpoint, I would keep this one on your radar and look for a slight dip before entering, especially if it drops in at around that $19 range. Now, a couple concerns I have with Central Pacific, however, is that the banking sector is likely to remain volatile throughout 2021 as things continue to play out with the global pandemic. Although the Biden administration looks like they're about to pass a much higher stimulus package, I worry about what will happen when the stimulus slows and the pandemic continues to affect communities. Although the vaccine is being rolled out, the COVID variant is a concern and may weigh on the banking stocks. The other concern I have for Central Pacific is that its sole regional base is Hawaii. Now, Hawaii has its niches for their economy, and if any one of those niches slow down, such as tourism, you can be sure the bank will be affected. Keep this one on your radar and look for the dips, as overall, I think it's a very well-run company, and they have launched various initiatives to bring their brand and services in line with today's banking technologies. Now, the last stock we're going to talk about is Amkor Technology, ticker symbol AMKR. Amkor provides test and packaging services to semiconductor companies, and while not many people know Amkor directly, their products are critical to the behind-the-scenes processes in the semiconductor and chip industry. So smartphones, televisions, automobiles, and data centers all use their products. Founded in 1969, Amkor is now headquartered in Tempe, Arizona, with over 30,000 employees and most recently, $4.8 billion in sales. Let's take a look at some of the financial metrics. Revenue over the last 5 years has continued to grow each year with a slight dip in 2019, but overall, revenues have grown 40% since 2015, and based on the recent Q4 and full year revenue announcement, it looks like revenue growth has exceeded expectations. Now, just like most stocks in 2020, the stock price did take a dip in March, but it has recovered nicely, closing in on a 52-week high of $19. Looking at the last 5 quarterly financials, net income jumped in Q3 September 2020 announcement. Amkor beat estimates, reporting 38 cents per share profit on sales of $1.35 billion. Both numbers were better than the 26 cents profit Wall Street had estimated and $1.25 billion in revenues. In addition to this, the company has also initiated a 4 cents per share per quarter dividend. Now let's take a look at the various valuation metrics. Looking at the discounted cash flow model based on free cash flow, we see a fair value of $28.80 per share, quite a bit above the current price of $17.85. The next metric is the multiples calculations on EBITDA, Amkor having a valuation of $12.84 per share, which is quite below the current share price. The last metric is the absolute PE method, and the calculation shows a fair value of $19.80, which is in line with the 52-week high and shows a slight upside from the current share price. So what attracted me initially to look at Amkor are two segments of their business that I think presents the most growth potential. In the mid-2020 earnings report, the company appeared largely immune to the effects of COVID-19 as smartphone and consumer product sales continue to rise. These two segments now make up 65% of the company's revenue. The company forecasts continued growth, particularly in the smartphone sector as customers upgrade to 5G models. In fact, on Tuesday, February 8th, Amkor announced for Q4 that it achieved a 16.3% year-over-year growth in net sales of $1.37 billion, beating analyst expectations. For the full year, net sales were $5.05 billion, up 24.6% year-on-year, with 6 consecutive year of positive free cash flow, with better than expected demand for smartphone and automotive products. Their outlook is also positive with expectations of another strong quarter with 15% year-over-year growth and full year guidance of continued growth for 5G deployment, high performance computing, IoT wearables, and automotive sector. Investors should remain a bit cautious of this stock's cyclical nature. Both the chip industry and its segments deal with sales cycles that can cause earnings to ebb and flow. Moreover, as a couple of valuation metrics show, Amkor does currently trade at its intrinsic value after today's positive quarterly announcement. So near-term investors may want to wait for a larger dip before getting in. Now, based on the absolute PE and discounted cash flow valuation, it appears that there are some good buying opportunities for long-term investors, which is why I'm putting this stock on my radar. Well, that is it. The 3 stocks I have my eye on for February 2021. As mentioned before, I am not a financial planner or investment advisor, so make sure you consult with a professional before investing. Don't forget to hit the subscribe button and like button. Every little bit helps. And I also want to hear from you in the comment section about your top picks for February and what you think about the stocks I've covered. Thank you for watching the Business Report Show. Remember to always be learning, always be investing. I'll catch you in the next video.